again, this is a public company. Every share trades every day. Everyone has a free option to exit anytime they want, just like any other public company. What we did instead of the typical SPAC is designed in a manner where it attracts a group of investors, very talented, smart investors, but they're not particularly interested in the ultimate target because they get a lot of upfront rewards just for investing in the IPO. And what I'm referring to is typical SPAC. For every share you buy, you get a piece of a warrant, and the warrant becomes saleable or transferable just after the IPO. And a lot of investors buy every, there's a, if you will, a SPAC mafia known for buying every share in an IPO, splitting off the warrants, creating either cheap stock or free warrants. That's a different game, if you will, than what we were trying to. And again, I'm not diminishing investors' right to pursue the opportunity for profit. So our structure, we maintain the same economics of other SPACs. You do get, a third of a warrant ultimately for every share you buy, but only if you invest in the target company. And that other benefit of the structure is because the shares will always trade with at least 2/9 of a warrant per share. By the time we identify a target, announce a transaction, the stock should trade up meaningfully. One, because we're going to buy a great company at a very attractive valuation for the minority interest that we're purchasing.
Yes.
Two, because the shares are attached to warrants. And as long as the stock trades above the $20 redemption price, no one redeems. And we eliminate the biggest problem of SPACs, which is they're scrambling to raise capital at the time they do a deal. Here we've raised $5 billion and the money will be there. Raised $4 billion, committing $1 billion. Money will be there at the time we do a transaction.
Bill, we're speaking, by the way, with Bill Ackman of Pershing Square on the occasion of the IPO of a new SPAC, Pershing Square Tontine Holdings, which is now up about 9% in trading. So let's move to the targets, Bill. First of all, do you have time to target? We know already that it's 2 years plus you can add to that. So time to target, and then what kinds of areas are you targeting? We know that you've given a list of 4 sort of elements that you really want to see and that you're looking at. Can you give us any more details?
Absolutely. So, we think the target universe is probably 150 companies total, $10 billion plus private companies. There are more that we're not including. We're not including in that subsidiaries of large corporations. We're not including some employee-owned businesses in that list. But the list is broader than 150. We think the top third will meet our quality thresholds. We're looking for a simple, predictable, free cash flow generative company with very high barriers to entry, with minimal exposure to what we call risks, extrinsic risk we can't control. We're looking for the super durable, great growth business that we can own for the next decade. That's kind of the target. I mean, this is what's interesting about this transaction is every investment banker around the globe is aware that we've just raised the largest blank check company in the world. We've got $5 billion of capital that we're looking forward to committing to buy a minority common stock interest in a company. It's the only such pool in the world. I refer to it in a way as its own unicorn. And basically, we're in a unicorn mating dance, and we want to marry a very attractive unicorn on the other side that meets our characteristics. And we've designed ourselves to be a really attractive partner. And that's what we're going to do. In terms of specific companies, I'd rather not name specific companies.